Okay, let's just address the elephant in the room right off the bat. If you are entirely new to technical analysis, opening up a stock chart for the very first time can feel, well, incredibly overwhelming. You're instantly hit with this barrage of flashing numbers, strange lines zigzagging everywhere, and seemingly random colors. It's absolutely no wonder that to most people, at first glance, the stock market looks completely chaotic and basically impossible to decipher.
There's this famous saying that a stock chart looks like a heartbeat monitor on caffeine, and honestly, that's pretty accurate, right? But here is the really exciting part I want to share with you right now. To a seasoned investor, that seemingly chaotic chart is not random at all. It is actually a perfectly readable map. It's a real-time tracking system of human emotion, supply, and demand. The chart is literally telling you a story of who is in control, the buyers or the sellers.
So, the big question we have to answer today is this: what is the chart actually telling you? Well, I promise you that by the end of this short explainer, we're going to completely demystify this visual language. We're breaking down technical analysis for absolute beginners so you can stop guessing, stop feeling so overwhelmed, and start investing with genuine confidence.
Here is our roadmap for today. We'll start with decoding the market map. Then we'll learn the language of candlesticks, finding the trend, the floor and ceiling, volume as our lie detector, and finally, making your next move. We're going to build this knowledge step by step.
Let's kick things off with part one: decoding the market map.
Welcome to what we like to call the engine room of wealth. Before we dive into any specific stock, we absolutely have to understand the foundation of this whole thing. If you want to decode any chart, you really only need to focus on three essential pillars: price action, volume, and trends. That's it. That's the whole shebang. If you can understand how these three elements interact, you will know exactly what the market is thinking at any given moment.
Which brings us to part two: the language of candlesticks.
Let's zoom way in on our very first pillar, price action. We're going to look at the absolute smallest building block of the market first, those little red and green bars you see everywhere. These are called Japanese candlesticks. Now, don't let the fancy name intimidate you. A candlestick is simply a snapshot in time. Each one of these bars represents a specific time period that you choose. Maybe it's 1 day, or maybe it's 1 hour. And within that single snapshot, the candlestick tells you exactly 4 things about the stock's price: where it opened, where it closed, the highest price it reached, and the lowest price it reached. So think of it like a giant tug of war between the buyers and the sellers. The color of the candle immediately tells you who won that battle for that specific time period. A green candle, that means the price closed higher than it opened, so the buyers won. A red candle means it closed lower, meaning sellers took the price. But look really closely at those thin little lines extending from the top and bottom of the colored bar. We call those the wicks. They are absolutely crucial because they show you the extreme highs and lows the price reached during the battle before things finally settle down at the closing price. A long wick on top means buyers tried to push the price way up, but sellers eventually overpowered them and shoved it back down. Moving right along to part 3, finding the trend. Now that we know the basic alphabet with our red and green candlesticks, let's zoom out a bit to read the whole sentence. We want to find the overall path of least resistance. There is an old saying in finance: the trend is your friend. And there are really only 3 directions a stock can go. You don't want to get distracted by the tiny daily wiggles. You're looking at the broader peaks and valleys. An uptrend is when a stock is making higher highs and higher lows. A downtrend is the exact opposite: lower highs and lower lows. Think of it this way: investing in an uptrend is like swimming easily with the current of a river. Investing in a downtrend, that's like exhausting yourself trying to swim up a waterfall. But hey, what about that third direction? Well, sometimes the market isn't trending up and it isn't trending down. It's really just catching its breath. We call this a state of consolidation. It's a sideways market where things are just bouncing horizontally between 2 invisible lines. It's essentially a holding pattern while buyers and sellers figure out what they want to do next.
That leads us perfectly into part 4, the floor and ceiling.
What's really fascinating about this concept is how that state of consolidation maps perfectly to a physical object, kind of like a bouncing rubber ball trapped inside a room. The floor of our room is called support. This is a specific price level where buyers consistently step in, thinking, wow, this stock is a great deal, which stops the price from falling any further. The ceiling, on the other hand, is called resistance. This is a higher price level where sellers are basically waiting to dump their shares and take profits, preventing the price from rising any further. Identifying these 2 levels is incredibly powerful. It's exactly how investors know to buy low down at the support floor and sell high up near the resistance ceiling. But rubber balls in the stock market don't just stay trapped in one room forever. Eventually, you get what we call the breakthrough. If a stock gathers enough momentum, it's going to smash right through that resistance ceiling. And here is easily the coolest dynamic in chart reading. Once a stock breaks through a ceiling, that old ceiling almost always turns into the brand new floor. The old resistance becomes the new support, and the stock starts exploring a whole new room above. All right, let's check out part 5, volume, our lie detector. So, we've talked about price, we've talked about trends, and we've mapped out our floors and ceilings. But to really trust what we're seeing, we have to look all the way down at the very bottom. See those simple vertical bars? That's volume. It represents the sheer number of shares being traded. Volume is your ultimate lie detector test because it shows you the true conviction behind any move. Let's compare 2 scenarios. If a stock jumps up 5%, but those volume bars are super low, that might just be a fake out. There's no real conviction there. However, if the price jumps and the volume bars are massive, well, that shows serious conviction. It means the big institutional investors, the whales moving millions of dollars, are actively buying in and pushing that price higher. Which brings us to a golden rule you absolutely must burn into your memory. Never trust a price move that isn't backed by volume. If the volume isn't there, the chart is probably lying to you. Finally, part 6, making your next move. Let's wrap this whole thing up and apply what we've learned. Ultimately, your goal is simple. Don't just watch the market, understand it. Reading these things is a visual skill that takes practice, for sure. But mastering these basics, candlesticks, trends, support, resistance, and volume, is the very first step toward becoming a pro investor. You're no longer just guessing at random lines, you are actively reading the map. So here is my challenge to you today. Pick one stock you've been watching lately. Pull up the chart and see if you can spot the trend, the floors, the ceilings, and the volume. Because once you realize that a chart is really just a mirror reflecting human greed and fear in real time, the real question isn't whether you can read the market, it's whether you're ready to profit from those who can't. Thanks so much for joining me on this explainer, and keep reading those maps.